Welcome to the Deep Dive. Today, we are strapping ourselves into the time machine, setting the dial for 1988.
1988. A fascinating year.
It really is. We're analyzing the shareholder letter from Fairfax Financial Holdings Limited. And this isn't just, a corporate update.
No, not at all. It's more like a foundational blueprint, wouldn't you say? A strategic roadmap written right after the '87 crash.
Exactly. So for those of you studying value investing, this is kind of a ground zero moment for understanding the early thinking of Prem Watsa, the Canadian Warren Buffett.
That's right. And our mission today really is to pull out that core investment philosophy, the operational mindset that defined Fairfax when the markets were, well, still pretty shaky.
Yeah, chaotic almost. And the big picture seems to be managing this paradox.
How so?
Well, 1988 saw Fairfax balance, really outstanding, sustainable operational success with some huge debt-fueled acquisitions.
Right. Stepping on the gas, expanding aggressively.
With this deep-seated, almost paranoid focus on risk guiding every single move, it's quite the balancing act.
You absolutely have to remember the context. The '87 crash, it created these incredible opportunities, sure, but it also just hammered home the need for capital preservation. So this letter, it shows a company grabbing those opportunities, maybe generational ones, while at the same time putting in these really rigid, conservative risk controls.
Okay, let's dig into that with the financial scorecard first, because the numbers, at first glance, they can be a bit confusing.
Agreed. The headline number looks fantastic.
Yeah, a 21.2% return on shareholders' equity, ROE. That absolutely crushed the TSE 300 index average, which was only around 11% that year.
So exceptional performance on the operating side, clearly. But here's where you might scratch your head if you're just glancing at the summary.
Right. Operating earnings per share jumped 29%. Good news.
But then their net earnings were actually down 11%, dropped from $16 million to $14.3 million. So why the mixed signal? If the core business is accelerating, why is the bottom line falling?
That is such a tricky juxtaposition. High operating returns, but the net number tanks. What were those specific one-off items they pointed to? The things that maybe masks the real strength in '87?
Well, the letter is, I think, a masterclass in being transparent about these non-recurring gains.
Okay.
They explain very clearly that the previous year's net number was, let's say, inflated by unusual gains. Specifically, they mention the gain on selling Morden and Hellwig and also a recovery of some income taxes.
Ah, okay.
And they make the case pretty convincingly that these things made the 1987 number, well, unsustainable going forward.
So the lesson here is ignore the shiny one-off gains and look at the engine itself.
Precisely. They actually highlight that their pre-tax earnings before realizing those gains shot up 50%. So this lower net earnings level in '88, they argue, is actually more sustainable. It represents the true growing earning power of the company.
That's a core value investing perspective, right? Always prioritize the recurring, predictable results over the temporary boosts.
Exactly. And efficiency was getting better, too.
Right. Book value per share up 22% to $10.13. And their effective tax rate dropped quite a bit, from 32% down to 25%.
So the core engine was definitely running more efficiently, which is vital because that core business insurance was facing some serious headwinds.
Yeah, the letter talks about the insurance cycle being definitively on the downswing in 1988.
Unlike the couple of profitable years just before, the wind was now against them, so to speak.
And the big principle that got tested was their commitment, their resolve to only write business if they thought they could make an underwriting profit.
Yes, the letter specifically says 1988 tested that resolve. Competition was fierce, premiums were dropping fast. It's tough to stick to your guns then.
It really is, especially when competitors might be chasing market share over profit. Look at the snapshot of their companies. Markel Insurance, for example.
Did pretty well, actually. Earned nearly 20% on equity, 19.7%. But its financial performance was, let's say, challenged. 102% combined ratio.
Okay, hold on. For listeners maybe less familiar with insurance jargon, what does 102% combined ratio mean in plain English?
Yeah, good point. That's the key measure of underwriting success, or lack thereof. It basically means for every dollar of premium they collected, they paid out $1.02 in claims and operating expenses.
So they lost 2 cents on the dollar just from the insurance operations themselves before any investment income.
Exactly. So maintaining that commitment to underwriting profit when your ratio is over 100, well, that's very difficult. It shows discipline.
It really puts that discipline in perspective. They also showed some good operational synergy there too, didn't they?
They did. Markel opened a truck driver training school up in Gulf, Ontario. Took it from concept to full operation in just 9 months.
Wow, 9 months. That's fast, focused execution. A good sign of management quality.
Yeah, but contrast that with Otter Dorchester. That subsidiary had an extremely poor year. Big losses in Ontario auto insurance, plus weather events hit them hard.
So what happened?
It led to a complete rethink of Otter's business strategy, which, also highlights something important. They weren't afraid to admit mistakes and pivot quickly.
Good point. And Sphere Reinsurance.
Sphere Re had another excellent year, earned 20% on equity. So good, in fact, that Fairfax bought out the remaining minority interest, consolidated that success.
Okay, but the really explosive growth story, outside of the core underwriting, seems to have been on the services side. This claims adjusting mega merger in the U.S.
Oh yeah, this was immense. They merged Lindsay & Newsome, or L&N, their existing U.S. claims adjusting business, with 2 other firms, Gordon Boyd and National Claims Services.
We're talking about putting together a company with, U.S. $18 million in revenue with another one doing U.S. $11 million.
That's right. Huge integration task.
And the physical scale is mind-boggling. Offices jumping from 62 to 136, employees from 350 to 775, all done in 9 months. That sounds like an operational nightmare.
Well, the letter does note L&N's returns in '88 were lower than expected because of those merger costs. They absolutely acknowledge the short-term pain.
So was it worth that kind of aggressive, fast-paced integration?
Yeah.
Seems risky.
Their focus was clearly long-term scale and potential. They were building a national claims adjusting powerhouse, this massive infrastructure, and the potential for future growth. They describe it as very exciting.
But they temper it, right?
Right. Classic Fairfax. Immediately after very exciting, they add no guarantees, though. Always managing expectations, even their own.
Fascinating. But this rapid expansion, it came with a hefty price tag. And that brings us to the moment where, arguably, the risk profile of Fairfax fundamentally changed.
You mean the Walwyn Inc. purchase?
Exactly. Late 1988. This was the massive contrarian bet, buying a 37% controlling interest in a retail stock brokerage. 75 offices, right after the market crash had decimated brokerages.
This was the ultimate value play, really, based on distress. But they were very specific about the conditions.
Well, really?
2 key things. First, the existing CEO had to agree to let Tony Arell become the new CEO. The people, the leadership, that was non-negotiable for them.
Human capital first?
Yeah.
Makes sense. And the second?
Second, they absolutely had to buy the shares at or below book value. And that book value had already been written down significantly because of the '87 crash.
And the price they paid.
Yeah.
It's just incredible evidence of the opportunity panic creates, isn't it?
Absolutely. They got that controlling block for about 1/3, maybe even less, of what it had traded for just before the crash in August '87.
You need serious psychological discipline for that. Buying when everyone else is, heading for the exits.
You do. But think about it. Merging a conservative, regulated insurer with a volatile stock brokerage. Wasn't that exactly the kind of cross-industry risk the market absolutely hated right after the crash? How do they justify mixing those cultures?
Through value and, crucially, through transparency. They were incredibly explicit about the risks involved, almost brutally honest.
What do they list?
3 major concerns. 1, the possibility of continuing losses if individual investors just stayed away from the market. 2, stock trading volumes declining even further. And 3, this is key, that the firm's main assets, the brokers, the talent, they might just not come back up the elevator. The people might leave.
Wow. So they knew they were buying a turnaround project, not some kind of sure thing.
Definitely not. And the major consequence of doing this Walwyn deal, plus increasing their stake in another holding called FM Acquisition, was that Fairfax was now, in their words, in debt.
Right. They financed these moves partly through a $7.5 million convertible debenture placed privately, and then about $20 million in actual bank borrowings.
Okay, wait a second. $20 million in 1988. Sure, it's significant. But for a company making over 20% ROE, why is that immediately framed as excessive borrowing? What signal were they sending by instantly prioritizing becoming debt-free?
This, I think, is the absolute core philosophical takeaway from the entire letter, maybe the most important part.
Yeah?
They immediately state they're worried about this level of leverage. Their top priority, literally stated as the top priority, above everything else, even immediate returns, was to get back to a debt-free position as soon as possible.
And the reasoning.
Terrifyingly simple. Profound, really, they state. Too many companies fail because of excessive leverage. Full stop. They saw the wreckage post-87 from highly leveraged companies and just decided that capital preservation, avoiding that specific fate, was far more important than any short-term profit boost from leverage.
Wow. That commitment to absolute capital protection, it leads right into their investment philosophy, which they lay out in Section 4.
Yeah, and the consistency of that value approach, especially in such a volatile time, it's really striking.
They anchored their whole strategy by quoting Ben Graham's wisdom, right, about the 87 crash.
Exactly. Never buy a stock immediately after a substantial rise or sell one immediately after a substantial drop. They lived that post-crash.
And they turned that wisdom into excellent investment results in 88, benefiting big time from those low valuations in manufacturing and natural resources.
Yep. They specifically mentioned major realized gains. Algoma Steel brought in $2 million, Stewart and Stevenson another $1 million. Good calls.
And their risk mitigation was just relentless. They even detailed their foreign currency strategy.
Right. Hedging all their U.S. stock investments and even the future income they expected from their U.S. subsidiaries like Shand, Moorhan, and the newly expanded L&N, all to protect against a rising Canadian dollar.
Just removing variables wherever they possibly could. Very systematic.
And formalizing that prudence, David Rooney and John Varnell developed formal risk management guidelines, specifically limiting common stock exposure. This is such a crucial practical takeaway for any investor listening.
What was the headline rule?
The limits were designed so that even a massive, almost catastrophic 50% drop in the stock market would not compromise their ability to keep writing insurance.
Okay, let's just pause on that. A 50% market drop. That's huge. And it wouldn't affect their core business solvency. That is the absolute definition of ultimate prudence, isn't it?
It really is. It shows they viewed their investment portfolio as the safety buffer, not the primary engine. The float was king.
Exactly. The insurance float, the core business, had to be protected at all costs. Any investment profit was just, icing on the cake. But the cake itself had to survive the absolute worst-case scenario.
Couldn't put it better. And this prudence, it ties directly back to their long-term vision, all centered on the power of compounding.
Yeah, they lay out the math right there for the shareholder. Achieve a 20% ROE for 10 years, and your book value grows to $63 per share.
And they don't just lay out the math in a vacuum. They set the bar, the specific historical bar they're aiming for.
Who do they compare themselves to?
They directly reference the wizard from Omaha, Warren Buffett, noting he compounded Berkshire Hathaway's book value at 23.5% annually over 23 years. They're basically telling shareholders, look, this is the goal, this is the league we aspire to play in, and we are playing the long game.
Credible ambition, but grounded in that conservative base. Okay, shifting to the human side of the equation, the letter really emphasizes that attracting very good people is the, quote, best sign I know of success in the future.
Clearly building an infrastructure, not just buying assets. They were focused on talent for the long haul.
And they named key additions, which shows how they built that trust, right?
Yeah, like Rick Salzberg. He joined from the law firm Torrey, but he'd already counseled them on every major deal since 1985. So he was a known, trusted quantity.
Bringing proven talent in-house.
And Rob Mills,
their new in-house real estate expert. Again, building internal capability.
And that philosophy, it extended even to their brand new investment banking department run by Paul Fink and Rob Mills. Yep. They explicitly state that department operates under the philosophy of downside protection first before looking at potential gain.
There it is again. It links directly back to the debt paranoia, the 50% market drop rule. It's just a completely unified philosophy across the entire company.
Total alignment. Value, protection, sustainability. That was the mantra.
And they don't shy away from the difficulties ahead. They close the letter with this really clear-eyed list of challenges for 1989.
No sugarcoating at all. They flat out predict that hitting the 20% ROE target again will be much more difficult.
Why? What were the specific headwinds they listed?
The ongoing insurance downswing, number one. Uncertain markets generally. Then the growing pains from that huge L&N merger integration, and of course, potential losses from the still volatile Walwyn investment. They knew 89 could be rough.
And finally, there's a specific nod to the importance of good counsel, good governance.
Yes, a specific mention of Director Robert Harshog, noting they made no major decision without his input since the company's big refinancing back in 85. It just highlights the value they placed on experience, on steady hands, especially during really uncertain times.
So, wrapping this all up, what does this deep dive into 1988 mean for you, the listener, the learner?
I think the letter really reveals a company executing this brilliant, maybe even difficult, dual strategy.
Yeah, explain that duality.
On one hand, they were aggressive, pursuing complex, potentially transformative acquisitions like Walwyn, the massive L&N merger, building scale, seizing those post-crash
That's
opportunities.
the growth side.
But at the exact same time, they were sticking rigidly to an ultra-conservative, value-based investment philosophy, defined by things like those strict risk limits, protecting against a 50% market collapse, and prioritizing getting out of debt above absolutely everything else. Buying aggressively, but managing risk like the most cautious traditional banker. I think the crucial lesson here really is that fundamental commitment to capital protection, even, maybe especially, during periods of rapid growth. Think about it. In the late 1980s, an era famous for leveraged buyouts and, frankly, sometimes reckless acquisitions,
Mm-hmm.
Fairfax immediately declared its $20 million borrowing, which, again, supported growth initiatives as excessive, and made becoming debt-free its absolute top priority.
So the final provocative thought for you to chew on.
Why did they deem that level of borrowing, which seems almost modest by today's standards, for that kind of expansion as fundamentally worrisome? What does that intense, almost visceral commitment to capital protection and avoiding leverage tell us about what true financial resilience actually means, especially when everyone else might be chasing growth